Okay, hi everyone, and thank you for joining us today. We have performed a sound check already, so hopefully you can hear us okay. If not, maybe try and turn up the volume on your computer or phone handset. This is a new way of delivering talks or courses for us, so please bear with us if there are any technical hitches. We've tried to think of everything. If the power goes down, the UPS will keep running for up to 3 hours. If the internet goes down, we have a backup connection. But Murphy's law being what it is, we'll hope for the best. The main thing showing on your screen should be my PowerPoint slide. Our webcam is also on, and the video from this should also show on your screen in a window smaller than the PowerPoint. You should also have a control panel like the one showing in this slide. This shows where you can enter questions. We will deal with questions at the end of the presentation. So we should all be set now. Okay, my name is Paul Byrne, and I'm the Managing Director here at Thesaurus Software. I'm a chartered accountant and I've spent many years in practice, most of those at partner level. I've always been a nerd and was fortunate enough to turn a hobby into a business over 20 years ago. Software development is now my full-time occupation. I look after our products Thesaurus Payroll Manager and Thesaurus Accounts, while someone a lot younger than me and a lot more techy is responsible for our Bright products, Bright Pay and Bright Contracts. I am fortunate to have really good people here working here, and their intricate knowledge of payroll-related issues has long since surpassed my own. One of them, Audrey Mooney, is joining me today, mainly to help with the questions and answers, but also to correct me if I get anything wrong. We originally estimated that 30 minutes would cover the content, and then another 15 minutes for questions and answers. The actual time may end up being somewhat less. Anyway, let's crack on with the Budget 2016 payroll changes. Okay, the budget changes affecting payroll and the rationale were aimed at reducing the marginal rate of tax to below 50% for those earning up to $70,000 per annum and to assist with the increase in the minimum wage from the 1st of January next. Although the reduction in this particular marginal rate is welcome, the top rate in Ireland is still 52%, and very unfairly 55% for self-employed. This low-lying fruit was the first to get hit when things went pear-shaped, and undoubtedly will be the last to see any reductions. The widening of the 3% band, previously the 3.5% band, to the upper threshold of €18,668 was to ensure that anyone on the new minimum wage should not stray into the 5.5% band, which is previously 7% band. Also, the new PRSI relief is specifically designed to try to ensure that someone who goes from the old minimum wage to the new minimum wage does not end up being crucified by employees' PRSI. I'll cover this further on. So the 2016 USC bands. These are broadly similar to the 2015 bands. The only change here is the second threshold, which has increased from 17,576 or 338 per week to 18,668, 359 per week. The rationale for this is someone earning the new minimum wage of $9.15 per hour can put in a 39-hour week without going beyond the 3% band into the 5.5% band. Okay, the 2016 USC rates. You can see from the table here that the big winner is the so-called squeeze middle, with the reduction of the rate from 7% to 5.5%. An employee earning $70,000 or above will see the biggest savings as they get the benefit of the rate reduction for the full band, €902 of saving to be precise. I won't go into the various levels of savings at different income levels. The newspapers were already full of these examples. 2016 USC exemption. Okay, the increased income exemption for 2016 is 13,000 compared with 12,012, or 250 per week compared with 231 per week. This is not something that requires a change in payroll software from 2015 to 2016, as it is for revenue to include the exemption if applicable in the P2C file that they issue mid-December to employers. Revenue may be called based on income from all sources, not just the income from the employee's employment with you. So it is not something you will know to or entitled to apply. The instruction must come from revenue. People can often get confused as to why there is a USC band below this exemption level. It is because the employee may have other income, and it may still be appropriate for the 1% deduction to be made on total earnings that fall within this lower band. So again, to reiterate, it is the revenue's call, and it will be included in the P2C if appropriate. Revenue have already issued guidance to payroll software developers on what an employer should do if they haven't received a P2C in time for the first payroll run in 2016. This guidance instructs that the same USC bands that applied to an employee in 2015 are to be used in 2016, but the new rates are to be used with these bands. So an employee on the standard USC cutoff in 2015 for whom a 2016 P2C has not yet issued will have their USC calculated using the old 12,012 to 7576 band at the new 3% rate, and also the old 17576 to 70,044 band at the new 5.5% rate. Again, you do not need to worry about this rule, as your payroll software will automatically import last year's bands and apply these at the new rates, unless overridden by a 2016 P2C, which in the vast majority of cases will be the case. It should be noted that the same logic applies to those employees on the reduced rate of USC. For example, medical card holders or over 70s whose aggregate income is less than 60,000 per annum. PRSI changes. So the weekly Class A threshold, from which 10.75% employer PRSI contribution applies, is increased to 376 from 356 per week. Below this, the employer contribution is 8.5%. This means that the AX class now applies to weekly earnings between 352 and 376. Previously, this was ridiculously low threshold of 352 to 356. New tapering PRSI credit to apply to weekly earnings between 352 and 424, a maximum weekly credit of €12. This second change means that the A1 class now starts at weekly earnings of 424, whereas previously this was 500. Again, all of this will be automated within the payroll software. So let's look at the new PRSI credit. So new tapering PRSI credit to apply to weekly earnings between 352 and 424. Without this new PRSI relief, an employee on the new minimum wage working 39 hours per week could come out with less in their pay packet. Using 2015 rules, weekly earnings slightly above the 352 means that 4% employee PRSI is deducted in all pay, whereas pay up to the 352 amount had 0% employee PRSI applied. This is something we have referred to in our software as a computational anomaly. Call it whatever you want. 39 hours at the new minimum wage of €9.15 per hour sees a weekly gross of €356.85. This would have employees' PRSI deducted of €14.27, which would have seriously eaten into any benefit they may have gained from the increase in the minimum wage. The weekly gross at the current minimum wage would be $337.35, so the total increase of $19.50 gross would have had $14.27 deducted, a net increase of only €5.23 in the week. So let's look at the calculation or the details of this relief in a bit more detail. The first thing to reassure you is that this will all be automated within the payroll software, and the calculation of the credit will show in the view or print calculation features within the software, which you can then give to or email your employees. Class A employee PRSI will continue to be calculated at 4% of gross weekly earnings. For gross earnings between €352 and €422 in a week, The 4% PRSI charge would be reduced by the new PRSI credit. The amount of the PRSI credit depends on gross weekly earnings. At gross weekly earnings of €352.01, the maximum PRSI credit of €12 per week applies. Just on this point, it would have been great if the maximum credit could have been €14.08, as this is the amount that net pay drops when an employee goes 1 cent over the €352. For earnings between €352.01 and €424, the maximum weekly PRSI credit of €12 is reduced by 1/6 of the excess of the earnings over the €352.01. So if weekly earnings are, say, €382, the excess is €30 in this case, and the reduction, the maximum credit, is 1/6 of this, in other words, €5. Therefore, the credit in this case is €7, being 12 less 5. I know it's very mathsy, but as I say, it is all going to be automated within the payroll software. So these are the recommended steps that you would follow if you're calculating PRSI manually. And we're using the example earnings of 377 as an example here. So first of all, you calculate the PRSI credit, and the maximum PRSI credit is €12. Then get 1/6 of earnings in excess of €352, which is €24.99. Then divide that by 6 to get €4.17. Take this off the maximum €12 to get the reduced PRSI credit, which is €7.83. Secondly, as before, calculate the PRSI charge of 4%, which is €15.08, and then take that €7.83 off the €15.08 to give the new weekly PRSI charge of €7.25. So from the perspective of a payroll software developer, one huge positive I would see with this calculation is that very few employers would want to be doing all of this manually or even using a spreadsheet. So all of these diehards will need software. One that's not really budget related, but it's a pension related deduction for 2016. From the 1st of January 2016, to give the effect of introducing a threshold of €24,750 from January 2016 and a threshold of €28,750 from September 2016, a blended threshold of €26,083 will apply from the 1st of January 2016. This blended threshold is because of difficulties that would occur in trying to introduce a new cumulative threshold mid-year, as in from September 2016. In 2015, the exemption threshold would increase from 15,000 to 17,500 per annum, and this will need to be implemented after the legislation is put in place and in time to be reflected on pay slips during 2015. Then from the 1st of January 2017, the exemption threshold will increase from 26,083 to 28,750. The enabling legislation for all of this is on its way through the Oireachtas, with the bill projected to become law on the 25th of November 2015. In the legislation, the rates of PRD will remain unchanged, and the lower rate will be swallowed up by the increased exemption threshold. Okay, so the increase in the rate of the national minimum wage from $8.65 per hour to $9.15 per hour was recommended earlier this year by the Low Pay Commission and is to apply from the 1st of January 2016. The Minister of Business and Employment, Jed Nash, said a single person on the minimum wage working 39 hours per week would be better off by €780 per year as a result. And he said the Commission would review the minimum wage rate again next year. So other changes. Okay, so proprietary directors should see an increase in their tax credits of €550 as a result of the new earned income tax credit. The tax credit is actually calculated at 20% of an individual's earned income, excluding earned income that is taken into account for the PAYE tax credit, subject to a maximum of €550. Where an individual has earned income that qualifies for both the earned income tax credit and the PAYE tax credit, the combined tax credits cannot exceed €1,650, which is the amount of the PAYE tax credit. This goes a third of the way towards addressing the current imbalance where an employed person gets €1,650 PAYE tax credit and the self-employed person only gets the €550 tax credit in this case. Apparently the remaining imbalance will be addressed in the next two budgets, assuming the present government is re-elected. All tax credit changes are handled through the P2C issued by Revenue. No software changes are required. Paid paternity leave comes into effect from September 2016, and it is not known as yet how employers will need to treat this through the payroll. If it is the same as maternity leave, then a revised P2C will issue from Revenue to take care of it. If it is anything like the treatment of illness benefit, then the employer will need to make appropriate adjustments in payroll, and software updates will more than likely be required. Hopefully it will be the former, as in handled through the P2C. So before we move on to the questions and answers, just a few things to add. The 2016 payroll software is currently finished in development and is going to testing shortly. Apart from the budget changes, some new features will be added. One of these is the ability to specify end dates for additions or deductions. This will be particularly handy for the likes of staff loan repayments or bike to work scheme. During 2016, we hope to roll out employee self-service. The main advantage of this being that employees can access their pay slips on a mobile device. And I should point out this will be totally optional for the employer as to whether they want to implement this particular feature or not. There are more webinars and courses at the address shown on the slide. CPD accredited courses are also being added. Next Tuesday we have a free employment law webinar, which is delivered by our in-house employment law specialist, Laura Murphy. And I'd highly recommend that you sign up for this one if you haven't already done so. Okay, so Audrey is going to help me now with the questions and answers. Okay, the first question we have here will be, software automatically update any employees on the minimum wage new rate from the 1st of January. I'll leave that one to you, Audrey.
Okay, no, that won't happen automatically. You will need to manually adjust and increase anybody that is currently on the minimum rate of pay of the $8.65 per hour.
The next one we have here is, how does USC work on the emergency basis?
Okay, so unlike PAYE, when an employee is on the emergency basis, there is no USC cut-off points allocated, so it is a flat rate of 8% for anybody on the emergency basis for USC.
Okay, and the other thing is there's no change in the emergency base of USC from last year, or from 2015 to 2016. Okay. One of our employees has just received a medical card. What do I need to do?
Okay, so if an employee has received a full medical card, they are exempt from the two higher rates of USC. This is information that needs to be given to Revenue, and Revenue would instruct the employer then that the employee is exempt from those two higher rates. If the employer doesn't do anything, you should advise the employee to instruct Revenue, and they will issue a P2C file then to the employer.
Okay, the question, I pay our weekly staff on a Thursday, which means we have 53 pay days this year. Is there anything I need to do on the software?
Okay, no there isn't. The software knows the rules that apply when there is a requirement for a week 53. That is that an extra tax credit and cut-off point are allocated on a week 1 basis. USC continues to be calculated on a cumulative basis, but it's all handled by the software automatically.
Okay. Another question I can see there is, will notes be available to download after the webinar or sent to attendees? Basically, we'll have this is recorded, so it will be up on, I think it's YouTube, Rachel? And slides as well, yeah. So hopefully that will be enough. Just one final question we have here. Why are the USC cut-off points shown differently on tax credit certificates?
Okay, this is a question that we get asked a lot. On the employee tax credit certificate, the USC cut-off points are displayed or shown differently. Employers should always be going by the P2C file or the employer tax credit certificate, and that gives them or displays them in exactly the same way as they need to go into the software. An important thing I suppose to mention is an employee tax credit certificate won't show any LPT if LPT should be deducted through the payroll. That does become the liability of the employer if it hasn't been deducted, so it is very, very important that you would always go by the employer tax credit certificate.
Okay. I think we're getting away with it. There's no more questions there. Okay, well, it's probably time to wrap it up. It's a lot shorter than we expected, so it's a bit easier to handle, I suppose. Okay, thank you very much for joining us, and hopefully you'll join us for more webinars. And to say that there's some CPT accredited courses that we're going to be rolling out the end of November, early December. The first one we have is to do with actually auto-enrollment, which I know is a UK implementation, but I know a lot of accountants here would have UK clients, so it's probably good to know what they should be advising and stuff like that. Sorry, there's one last question coming in there. Can you repeat the LPT issue, Audrey?
Okay, so if an employee has opted to pay LPT through their salary, this is not something that is displayed on the employee tax credit certificate. So when an employee brings in their tax credit certificate for you to use, you're not aware that they have opted to pay LPT through the salary. But because the instruction was issued to you by revenue, it does then become the employer's liability.
So it's important to always work off the instruction issued to the employer, not the one that's issued to the employee.
Exactly. So most people now are registered with Ross. So, I mean, the easiest thing and the most accurate thing to do would be to download the P2C and import it into the payroll, and then you can be sure that everything is handled correctly.
Okay, thank you very much,
Thank
Audrey
you.
and Rachel. Thank you, everybody.
Thank you.